Hello everyone, welcome back to my YouTube channel IB Made Easy by Garima Chhabra. Today we are going to study the next part of first chapter of macroeconomics. The topic that we are going to discuss is national income accounting and the circular flow model. Circular flow model is that macroeconomic model which tells about the level of economic activities and national income considering different decision makers. Decision makers include households, firms, and government. So, what happens? Households provide FOPs to firms, in lieu of which FOPs get factor payments or factor income. With the help of these FOPs, factors of production, firms produce goods and services and sell these goods and services to the households. Households make payment of for these goods and services, and they make expenditure on them. This is the situation of closed economic system. In the open economic system, we have leakages, also known as withdrawals, and injections. Leakages are something that takes money out of the economy, that decreases the money supply in the economy. There are three leakages: savings, taxes, and imports. These three components take the money out of the economic system. Then we have injections. Injections means something that puts money into the economy. We have three components here: government spending, export earnings, and investments. Now, the level of economic activity depends on the relative size of leakages and withdrawals. If you are taking more money out of the economy and putting less money in the economic system, that is, withdrawals are more than injections, then economic activity decreases. Whereas when withdrawals are less, whereas injections are more, then the economic activity increases. And when both of these are equal, economic activity remains same. This is a situation of when economy is in equilibrium. This was all about circular flow of income model. Now the next topic that we are going to start is nominal GDP and real GDP. GDP, as you all know, is the value of goods and services produced in an economy over a period of time. Nominal GDP means when we are talking about value, we take price and quantity both. And when we are talking about nominal means the prices that you are taking are current prices. GDP taken at the current prices. Now, what is the meaning of current prices? Current price means the actual price of goods and services at the time when you are calculating the data. That is current price. When you are taking the current prices, it does not account for inflation. It does not count whether there was increase in the general prices compared to the previous years. Contrary to this, we have real GDP. Real GDP takes the value of GDP at constant prices. It says that we need to compare the actual quantity produced, so we will keep the constant prices. We will keep the prices same. It takes into account the inflation and it is always better for the comparison. I will explain you this with the help of an example. So we have price and output for year 2020 and 2025. Since nominal GDP takes the value of goods and services at current price, for 2020, nominal GDP would be 10 into 5, 50, and for 2025, it would be 80. Nominal GDP is showing that there is increase in the GDP over time. But in actual, we know that there is increase in the price and there is actually decrease in the output. Real GDP says no, we actually need to see whether there is increase in output or not. So we will keep the price constant so that GDP does not change because of change in the prices. It only changes when there is change in the output. So real GDP for 2020 would be price of base year. Base year would be given to you here. 2020 is the base year. You don't have to worry about it. Price of base year and output, it would be 50. And then for 2025, we will keep the prices constant to make the comparison of the output. And we will take the price of base year, that is 10. And 10 into 4, 40. Real GDP shows that there is actually decrease in the GDP, which means that though nominal GDP is rising, but it is because of the inflation. It is because of the rise in the general prices. This is what I was talking about earlier. Real GDP takes into account inflation. It tells that whether there is actual increase in the output or not, but nominal GDP does not take into account the inflation. If I say that nominal GDP is 4%, it means there is a part of inflation in nominal GDP. Inflation rate is 3%, so actually real GDP, average person's income has risen by 1%. Now, since we know real GDP gives us the actual value, how can we convert nominal GDP into real GDP? With the help of GDP deflator. What is GDP deflator? GDP deflator tells us about the level of inflation. It tells us to what extent has the prices changed over time, so that adjustments can be made for the nominal GDP, in the nominal GDP for inflation. The formula for real GDP is, to calculate real GDP with the help of GDP deflator, is real GDP is equal to nominal GDP divided by GDP deflator. We'll do a question for this. These kind of question comes in paper 2 and paper 3. Use the data below to calculate real gross domestic product, real GDP in 2019 and 2020. If you calculate for 2019, it will be nominal GDP divided by GDP deflator. We'll multiply it with 100 to get the real GDP. It will come $243.7 billion. And for 2020, it will be 262.4 divided by 108.5 into 100. It gives us $241.8 billion. Now you have to explain your results. So our results shows that the economic output declined in real terms between 2019 and 2020 despite a rise in the nominal GDP. Now I wanted to tell you one more thing. We take the price of base year as 100, and if it is given that GDP deflator is 106.5, we assume the price of base year to be 100 and GDP deflator is given 106.5. It means that the prices have increased by 106.5 minus 100, that is 6.5%. This is how you calculate inflation with the help of GDP deflator. Now we have nominal and real GNI. You know, GDP is the value of goods and services that are produced in the domestic territory of a country. But when we talk about GNI, GNI is basically the output produced by the nationals of a country, irrespective of their geographical location. It does not take into account the domestic territory, but the output that is produced by the nationals of that country. So anything which is produced by the foreign nationals in the domestic territory will be deducted, and anything that is produced by nationals of the country even out of the domestic territory of the country will be added. So GNI is basically GDP plus net factor income from abroad. What is net factor income from abroad? Net factor income from abroad is basically factor income from abroad minus factor income to abroad. Factor income from abroad means money sent by the nationals of the country who are working outside the country, whereas factor income to abroad means foreign nationals working in domestic country but are sending money out of it. So the formula for GNI is equal to GDP plus net factor income from abroad. Now the nominal GNI will be value of GNI at current prices, whereas real GNI will be value of GNI at constant prices. Next term that we have is real GDP or GNI per capita or per person. GNI per capita means basically how much national income comes under the every person of that country. It determines the value of national income per person. It is a way of measuring standard of living. This is the GDP or GNI of a country, but if we divide it with the population, we will get to know how much nation's income comes for every person. So real GDP or GNI per capita will be real GDP divided by population. Next term is real GDP GNI per capita at purchasing power parity. Now what is purchasing power parity? Purchasing power parity means at what exchange rate can a basket of goods be bought in two different countries? It equalizes the purchasing power of two countries basically and accounts for taking the differences in cost of living and inflation. For example, if the exchange rate right now is $1 is equal to 90 Indian rupees, it does not mean that for $1 in USA, the cost of the packet of chips is $1 in USA, whereas it is $90 in India. No, it is not the case. Purchasing power parity says, let's suppose this is a cup of cappuccino. It can be bought in USA with $5, whereas it can be bought in India for INR 200. Purchasing power parity says keep these two values same and you will get to know the cost of living of that country compared to other country. That means $5 is equal to 200 Indian rupees, because these are with these amount we can buy the same goods and services. It means that $1 with $1 I can buy something that is for 40 Indian rupee. But actually the exchange rate is $1 is equal to 90 Indian rupee, which means you have to pay more in actual. It shows that INR is undervalued and dollar is overvalued. Purchasing power parity actually adjusts. It is basically the adjusted exchange rate rather than market exchange rate. It shows you the value of two currencies that can be used to buy the same goods and services. What is the value of two currencies that can be used to buy the same goods and services? It considers differences in the cost of living and the inflation of that country. Let's do this question. From the data below, for Taiwan, calculate the percentage change in the country's GDP per capita. So for 2018, if we calculate, GDP per capita would be 590 divided by 23.59. GDP divided by population, it will give us 25.01 $1,000, and for 2019 GDP per capita will be 605 divided by 23.60. It will give us 25.64. And now we have to calculate the percentage change. Percentage change is equal to 25.64 minus 25.01 divided by 25.01 into 100. It will give us 2.5%. Thank you for watching this video. Let me know in the comment section your doubts and the topics that you want me to discuss. Like, share and comment to watch more such videos.